And just to confirm, I'm going to start at 2:10 Eastern and I have until 2:40 Eastern.
That is correct. Yes.
Yeah, great.
We are now live. So, hello and welcome to those of you joining us just a few minutes early. My name is Charlotte. I'll be your Money Show host for this session. I do have Austin here with me in the Zoom room, and we are ready to begin his presentation on time at 2:10 p.m. That is Eastern Time, coming up in just a few short minutes. If you are looking for something to do while you wait, please feel free to scroll on down to Stansbury Asset Management's virtual booth below the video player for some more information and handouts that you can download if interested. Thank you so much for your patience. I hope you're enjoying the show so far. Once again, for those just joining us, we'll be getting started in just a few short minutes. Hello again, and welcome to those just joining us. This is your Money Show host popping in just to let you know that the next presentation will begin on time in a couple of minutes at 2:10 p.m. Eastern Time. Hello, everyone, and welcome to the session. It is my pleasure to introduce Austin Root. He's the Chief Investment Officer of Stansbury Asset Management, where he oversees investment strategy across the firm's portfolios. Now, to our live viewers, please share any questions you may have throughout this session in the live chat box. It is located on the right-hand side next to the video player. If time permits, we'll do our best to get to some of those at the end. Now, without further ado, I will hand the mic over to you, Austin. I'm here if you need me, but the floor is all yours.
Fantastic. Thanks very much. As the moderator noted, I am Austin Root, Chief Investment Officer at Stansbury Asset Management. And on behalf of all of us at SAM, thank you for taking the time to join us. We're going to make great use of your time. We've got a really interesting, kind of a mouthful title here, but really a mindful amount of information we want to go over. And that is really, look, how do you both grow and protect your capital and your wealth in the second half of this year, and frankly, beyond that? To that end, I recently received a question to this end from a top client of ours that was really noteworthy, and I want to share it in part because of who this client was. It's a senior executive at one of the largest AI and technology companies in the world. In other words, this is a person that is at the forefront of innovation. And even he is wrestling with the same questions that I find my team and most of our clients and investors are grappling with. And that is really, how do I both protect and grow my capital? And here's the question itself. Even though I don't fully buy into the doom and gloom extremes, it's hard to know what to expect from the market with AI, heavy debt loads, et cetera. How do we protect my capital in the event of a massive drawdown? But at the same time, how do we make sure we avoid being out of the market on a rapid recovery like we've seen happen a number of times over the last 6 years? And that's a great question. How do we both grow and protect our capital in light of where the market is right now at all-time highs? Well, we think that you need to employ two of Warren Buffett's superpowers. The first is making sure you understand the critical importance of not losing money when it comes to long-term success. After all, Buffett is most famous not for a quote, not about making money, but for this quote. Rule number one, never lose money. Rule number two, never forget rule number one. Um, so why is this such a vital, important thing? It's because big losses in your portfolio really impair and limit your ability to make the best long-term decisions. They can be emotionally limiting. I've talked to many clients who over the years have told me, during the great financial crisis, when I saw my retirement account drop by more than half, I just pulled out of the market. I couldn't deal with it emotionally. Of course, that proved to be a very inopportune time to pull out of the market. But when you suffer a big loss, it's understanding that can be emotionally limiting and limit you from making great decisions. It can be financially limiting. Think about folks that are on margin or forced to sell their liquid things because part of their portfolio is illiquid and they do it at fire sale prices. What I want to talk about today, though, which is something that I think people don't fully appreciate, is the math behind how difficult it is to recover from large losses. So let's do this in a very simple example. Um, Investor A and Investor B both generate the same simple average return, 10%. Investor A does this with half his years being good. The odd years are good years where he generates 40% up returns. And then the bad years, the even years, he loses 20%. Simple average of 10%. Investor B, steady Eddie, he generates 10% year in and year out. Now, Investor A still will do well over a 20-year investment horizon, more than tripling his capital. But look how much better Investor B does, more than double the return of Investor A, or nearly 7 times his capital. Here's a graph to show that. Investor B being the blue upwardly sloping line, and the sawtooth is Investors A up and down returns. Now, we've been talking about simple average returns, but as investors, what we care about are compound average returns. What is that average annualized rate or CAGR that you would have to compound your return to generate that end result? Investor B's is simple. It is compound return is the same as a simple average return because there's no up and down, 10%. But look at Investor A, only a 5.8% compounded return with those big loss years. In other words, if Investor A just was like Investor B and was steady Eddie, but generated just a 6% return, that would have been better than their up and down return because it's so difficult to work your way out of big losses. So we want to avoid those losses. And yet, um, we want to just not just protect our capital, do we also want to grow it? It does beg the question though, with markets back to all-time highs, expectations for future growth and forward multiples at also extremely high. Should we stay invested? That's a fundamental question, and I will tell you, we think about this a lot. We are nimble. We're not stuck in our ways, but our answer to that right now is emphatically yes. And the first reason is that we believe the growth required to meet those high expectations and to generate strong returns on your capital is likely to happen. Why is that growth likely to happen? Well, the setup in the economy is very strong. First off, monetary plus fiscal policy is extremely accommodative. We can debate how much monetary policy is accommodative. Certainly, fiscal policy with all the deficit spending, while it may not be great for the long term, is certainly accommodative for the short term. Bond yields and defaults, relatively low. Maybe they've been elevated a little bit. We'll grant you that, but on a long-term basis, relatively low. CapEx and investment. This is a strong area. We are seeing high levels of CapEx, and importantly, seeing increasing levels of CapEx, not just at the AI hyperscalers, but across the economy. Productivity. We've been seeing productivity gains in the economy. This is the amount of output per worker go up. It's high and it's increasing. And then finally, the earnings and the economy itself have been resilient through tariffs, through a conflict in the Middle East. Very strong returns. This all sets up well for what we believe is a strong and continuing steadily growing economy. And ultimately, while we can sawtooth around different times in the market, growing earnings will lead to upwardly moving stock prices over the long run. The second reason to stay invested is just so painful now to not be invested. As we know, the value, the purchasing power of your dollar is going down over time. Part of that is a result of the government owing more and more money. And if you owe a lot of money from yesterday, if you make the dollars worth less in the future, well, then you owe less in future dollars. So expect more of that. But it begs the question, how do you protect yourself? Well, we believe that Jack Dempsey had it right when he won all those championship fights. Your best defense in this current environment is a good offense. In other words, in order to protect your purchasing power, to protect yourself, you need to own productive assets. At the core of every investor's portfolio ought to be those world-class businesses that can defend and grow your purchasing power by compounding earnings at a high rate over a very long period of time. This is what we're talking about, and this is actually Buffett's superpower number two, appreciating the power of long-term compound interest, or CAGR, as we call it, compounded annualized growth rates that are very high. If we think about the stock market, the S&P 500 itself has been a nice compounding machine. If you look at the period over which Buffett ran Berkshire Hathaway from 1964 to 2025, just $1,000 in the S&P 500 increased and compounded to nearly 440 $500,000, assuming reinvested dividends. But look at Buffett's compounding power, more than 55 million with just that $1,000. Incredible power of long-term compound interest. So before I get into that, I don't want to. I want to be sure that your folks are clear that we are very aware of many of the risks out there that could derail this market. All of this investment in AI could fall short on the return on investment, on the productivity gains that were expected, or on the net job growth that many of the bulls expect, or frankly, some combination of all three of those. The low and middle market consumers could finally tap out. We've seen this K-shaped economy, and yet the low and middle market consumers are still kind of powering through there. We could have heightened geopolitical tensions that derail the global economy, or we could have some other black swan event that's unforeseen. Um, so again, are we able to produce asset growth and protection at the same time? My answer is yes. In fact, that is why we created Stansberry Asset Management 10 years ago, to provide actively managed, world-class way to invest your wealth, and also increasingly over time to help you plan for your wealth. So we launched it in 2016. We've expanded to help not just individuals, but families and institutions. We have offices across the world. We actually are across the country, and have some employees across even beyond that. We're in alternatives, and we provide holistic financial plans. Our growth in assets has been strong even in weak periods of the market. If you remember 2022, markets being down quite a bit, our assets grew in no small part because of the outperformance we afforded and provided our clients in a down period. Similarly, last year, if you can recall, the extreme drawdown that we saw in the market around Liberation Day, more than 90% of our assets are in those five core strategies that were all materially outperforming. In fact, every one of our strategies was either up or outperforming its benchmark. Like our treasury strategy was up and not included in those. But the point is that the vast majority of what we were doing provided really that stability that we want, because we don't want to lose capital and we still want to grow. So how do we go about doing that in today's environment as we look forward to the second half of the year? The first thing is security selection matters. I know active managers like to say that all the time. It really matters now. And so what are we looking to do? We're looking to own a certain type of investments, and we're looking to avoid other types of investments. Here's an example of those things. We do believe in the power and the productivity gains that eventually come from AI investment. What we really believe in, though, is that that investment will be pervasive. So you want to own those companies that are either definitively beneficiaries or perceived to be beneficiaries. We want to look at companies, again, with the K-shaped economy that are focused on higher income consumers. In an environment where we believe inflation will continue to be a thorn in the side for many businesses, you want to own businesses that have pricing power. Look, we need to own companies that are not antagonistic to this administration currently. And finally, we talk about wanting to own high quality businesses. What does that mean for us? It's really these things. We love to own industry leaders. Industry leaders tend to do even better and gain more share during periods of dislocation and weakness in a market when the weaker players exit the market. So if we're worried about the world, we want to lean in even harder into those world-class businesses that are leading their own industries. They have healthy margins. They've got strong balance sheets, strong returns on incremental capital invested in their business, and perhaps overlooked by many investors, focusing on strong ethical leaders that run their business well, that are great capital allocators and have skin in the game and own stock right alongside us. What's an example of one of these productive assets that we like, that hits on a lot of these themes? I'll give you an example of a company. It's called Parker Hannifin. Now, this is a leading player in the large motion and control industry. Think of Parker Hannifin as producing, as being involved, having its finger in the pie of anything that involving industrial motion, mechanical, interconnected technologies, electrification. So we like to say we expect the world to have more flight, more digitalization, more electrical demand. And frankly, Parker Hannifin is in the midst of all of that, in the middle of all that. This is a slide that Brookfield Corporation recently shared with their investors, and I share it here. It just shows that, look, while most of the media has been focused on AI and the most obvious AI plays, whether they're the hyperscalers or the semiconductors and memory players, or maybe even a couple names like Comfort Systems or Quanta that provide the construction for those data centers. There are a lot of ways that infrastructure is going to be built out to support the AI economy globally. And these are a lot of the ways in which a company like Parker Hannifin PH can really benefit. So use this as a tool for investing in types of businesses that really can benefit from the investment that we see accelerate. Not only is it high, but it's accelerating in these parts of the market. Second thing to do to grow and protect your capital is you need to be nimble and tactical. We believe investing is seasonal, and so you just set it and forget it is a very tough way to invest nowadays, especially with this level of innovation and frankly level pace of change in the economy and in technology, and frankly in central bank policy that can also upend that. So how do we do that? One of the ways that we do that is we have a strategy that we focus on called SAM Tactical Select. We like to think of it as providing the best of both worlds. We think too many investors are either um, fundamental qualitative investors or technical quantitative investors. And tactical select is our way to marry those together. Now we start with the fundamentals. We start with our favorite investment ideas where we've done the work, we own them in one of our other strategies. And then what we utilize is a quantitative analytical overlay. Utilize it as a risk management tool that basically helps us know not only what to own, but when. And what that means is that we're constantly monitoring health risks, health and risk monitors, making sure we're not out over our skis on any certain number of factors. Here are some examples of the factors that go into this model. I'll give you one example, kind of down middle of the page, earnings revision. It turns out that when companies are positively revising their earnings upwards, the correlation of stronger earning of stock performance to that is very high. So we like that as a factor for the health of a particular company. So among some of these other ones, we're really focused on adding this to our qualitative fundamental bucket as well. An example of something we've exited because many of these factors on this page were going negative for us is Fiserv. And that's Fiserv, I think, is in a relatively solid industry of payment processing and merchant acquiring. But the tactical select exited and really saved our investors more than 70% decline after we sold. And frankly, Fiserv has not recovered even yet to today. So what we do with tactical select and what this affords us the opportunity to provide our clients is really what we're talking about. Generating strong returns, but minimizing the downturns. And so we started this in February of 2023. The 3-year annualized returns are strong. So if you just kind of look across this, we're generating returns above the market on an annualized basis, but importantly, only at 3/4 of the beta or volatility, and most importantly, in terms of max drawdown, only kind of 40% of the drawdown of the overall market. These are the types of return profile that I think is what you should be looking for in this market, where look, asset prices are high, expectations are high, but we think there's still a lot of growth going forward. So is there a way that we can proactively position ourselves to enjoy that growth while also making sure we're protected on the downside? The next way we do this is to lower your portfolio correlation. If we think about the traditional 60-40 portfolio, 60% equities, 40% bonds, that Markowitz portfolio from way back when was supposed to do that. And yet, at many times, it hasn't done that. And why? It's because the correlation was way too high. So if we think back to 2022, that white line with the blue underneath it was the S&P 500 index as it was dropping 20% or more through the teeth of the downturn in 2022. That ballast in your portfolio was supposed to be fixed income. It wasn't. Why? Well, when interest rates go up, the value of bonds with fixed coupon payments goes down. And so I'll tell you, for our clients heading into 2022, we didn't own a single bond across a single one of our strategies because we saw this. Now, we took a little bit of flack early on, wondering why we were holding cash. But to the great benefit of our clients, that was a correlation decision we made. We did not feel like bonds provided the ballast or the low correlation that they were supposed to provide when interest rates are going up. So, what are other ways that we try to lower the portfolio correlation? Well, one example is we really like merger arbitrage situations where we own the target company when it trades at a sufficient discount or spread to the takeout price. Now, that type of situation is not without risk, but the risk we say is idiosyncratic and it's not correlated to the overall market. It is dependent on whether that deal actually occurs as contemplated. And so over time, and as risk dissipates, that spread compresses and we get to own that. It is a return profile that is not correlated with the overall market. So we like adding something to that, like that, to our overall client's portfolio. Another area of low correlation is owning gold. Now, obviously, gold has done very, very well for us and for investors that have been in gold. I just want to say that we don't think of gold as a end all to be all investment for all times, but it absolutely is a diversifier and a chaos hedge. Think about now in each of these graphs, the gold is on the red line. Think about what gold did during the tech bust from 2000 and beyond. What it did during the great financial crisis as stocks lost more than half their value. What it did during COVID when it also provided nice ballast in your portfolio. Even what it's done, recently in 2025 and up until recently provided some strong returns. Now, I want to caution folks, anytime we talk to our investors about gold, recently we've shown this chart, which is to say that gold is a great diversifier and chaos hedge. It will not necessarily go up and to the right the way that has recently. Now, I will say the conditions are set such that we have a favorable bias for owning gold even today. We have an environment where we expect global volatility to be higher. We expect trust of fiat currencies around the globe to be lower. And we expect the debasement of those fiat currencies or the pace of devaluation or of inflation also to be high. All of those things are conditions we believe are favorable to owning gold. Now, what is our approach to owning gold? Well, we do want to own the physical precious metals, but we also want to diversify that across a number of other businesses. We like owning the major producers, the ones that generate actual good returns on investment. Not every gold miner does. It's a tough business. We want to own the emerging producers that really are valued more on the pounds in the ground that they have rather than the production they have right now. And then The best business model in this industry are the royalty or streaming companies that generate capital or profits from their previously invested capital, whether the miners themselves have a higher or lower profit margin, just generating on actual the royalty stream itself. So doing that is a great way to lower your correlation, and we like doing that. Quickly, we'll go to the last point, and that is we want to broaden our investment base. Um, when I talk with clients, I think a lot of them are surprised by this question, and I'll just pose it to you before giving the answer. What percentage of US companies, large US companies, those with revenues greater than $100 million, would you estimate are public companies? So large companies, how much are public? How many, what percentage are public? Turns out only 13%. This is as of the end of 2024. The number may even be smaller today. That's for a variety of reasons that we know. It's tougher to become a public company in terms of the capital costs for Sarbanes-Oxley. There's more capital available in the private markets, et cetera. But the reality is that if we want to broaden our investment base, one great way to do that is to invest in private markets, invest in alternatives. And I think folks have shown these charts. This is a return profile with varying levels of fixed income and equities, not including alternatives, where the vertical axis is your return profile and the horizontal axis is your volatility profile. So the higher returns, the more the volatility. When you add alts to your mix, a fantastic, a magical thing happens on average, which is that you increase your return profile, but actually reduce your risk. And part of that is broadening your base. The other part of that, frankly, is you're accepting illiquidity in part of your portfolio. So for those clients that are accredited investors and are able to take a little bit of illiquidity in their portfolio, we believe it's the right time and the right asset to own is private credit. Yes, I said private credit. Despite headlines to the contrary, we think this is a good season to own private credit. It's other than SpaceX and Anthropic and OpenAI, it's a closed IPO window. Lending standards are very tight for banks. Interest rates are high, and there's lots of private equity dry powder out there. All of these are conditions that make it, for us, a time that we'd rather be a lender rather than a borrower. Now, the traditional way of doing private credit is not for us. We don't want to be junior and unsecured. We don't want to be in these semi-liquid or interval funds that you only get your money back if no one else wants their money back at the same time. We don't really want to be in the large private equity deals where the managers are really just focused on generating and deploying as much capital as possible. We really, frankly, are targeted on the opposite. We want to be higher up the capital structure and senior secured. We want our duration of our assets and liabilities aligned. We want to avoid those competitive deals where we actually can provide the strategic capital, and where the manager's focus is generating high rates of return for investors. Now, currently, we love corporate private credit of certain sorts, but we also really like another type of private credit, and that is one that's supported by a persistent multi-decade imbalance between demand and supply, and that is secured debt backed by residential real estate. If you have an interest in talking more about that with us, we would love to explore that with you. But most importantly, and I'm just going to end with this. Um, you know, anything I've talked about today may not be perfect for you, or it may be right up your alley. We like to say there's no one size that fits all for investing. That's why we do have the 10 strategies plus our alternative investments. We like to say every investor has some combination of just three goals. They want to generate more wealth, they want to generate sturdy current income, or they want to maintain their wealth, or they have a balanced goal of that. Talk to us. We love to schedule a complimentary portfolio review to walk through a holistic approach of how to do that for you. So with that, I thank you for your time. If you have any questions, please follow us on social media. Couple disclosures. I'm not sure if I let much time for questions, but I'll turn it back to the moderator now.
Fantastic, Austin. Thank you so much for a wonderful presentation. Now, we are out of time right now, but I appreciate everyone who's tuned in today, and be sure to stay tuned as we do have more in store for you in this Money Show Virtual Expo.
Thank you.